learners, welcome to our session today. I am your instructor, CPA Ringo Frederick. And the concept that I want us to study today is about accounting for partnership. And whenever we are talking about changes in ownership of a partnership business. And specifically, we are looking at financial accounting. Because remember, anytime you're talking of changes, we will be looking at it at a whole different levels. And we had already introduced the whole concept of partnership when we started. So today is just a continuation of that. And looking at this concept of changes in ownership in partnership, you'll find that these changes can occur as a result of so many things, right? First of all, we can always talk about, number one, admission of our partners into a new business. Talk about admission. We can decide to admit a new partner. With this admission, you'll find that the ownership of the existing partnership will change. We can talk about, number two, retirement, right? Talk about retirement. Probably at this point, you'll find that I will be having a partner, and due to one or two reasons, or rather maybe when this partner reaches his age of retirement, or even before the age reaches, this person can just decide to retire. And as a result, what will happen? There will be changes in the partnership structure, right? So that will change the ownership of the partners. Then, God forbid, we can also talk about the death of a partner, right? Also, death can lead to changes in ownership. We were operating as three partners. Then one of our partners, probably by bad luck, he passes on. What will happen? Our business, yes, will still continue, but we'll find the structure will change. In this case, the structure of ownership will tend to change. We can also talk about another cause of change of ownership. This is, of course, dissolution of a partnership business. Dissolution can occur in so many cases, probably due to disagreements. In this event, whereby we'll say that we will no longer operate as partners because we are having some misunderstandings. So rather, there's a very huge difference that we cannot sort it out amongst ourselves. We just decide, you know what we can do, let us just dissolve this form of partnership business that is in existence. The other key thing that can also lead to changes in ownership, we can talk about conversion of partnership into a limited company, conversion of a partnership into a limited company, because of growth, right? You'll find that probably at this point our company will have grown. In this case, you'll find that yes, we're operating as partners, but you just decide to do what? To make it as a limited company, whereby to that event you can also invite the public to buy shares. Say, for example, maybe assuming today, maybe we're having a company which has grown. Initially, we're operating as partners, but we decide that, you know what, this business has grown. We can also invite the public to purchase shares on the same. So these are causes which might lead the ownership of the partnership to change. But for this, at this level, you'll find that our key area of concentration will be on the first three: admission, retirement, death, and dissolution of partnership. Dissolution of partnership was just introduced the other day. Initially, it wasn't at this level, but it was introduced, and that is to say, it is also very important that we look at what? Dissolution. You'll find that the first three, ideally, the treatment of changes in ownership will be the same. So once you're done with one, it will see if we'll have tackled the other two. So what we are going to do, we are going to start with the first three: admission, retirement, and death. And as I've said, the treatment of this change, the treatment of these changes, you'll find that they just be the same, except for dissolution, which will be quite different because you'll have to open new accounts. Whereas for conversion, we are going to do it at financial reporting when you'll have advanced to the upper levels, right? So at this point, we can start with the first, admission, retirement, and death, because I've said the treatment is just the same. The treatment of this is just the same. So that's what I'll wish us to start with, and therefore let us look at it and see what it entails. So looking at admission, retirement, as well as the death of a partner. So we are talking of admission here. We're having admission. We're having retirement. We're talking of death of a partner. So when we are looking at these three cases, you'll find that once admission occurs, retirement or death, there's one thing that will always tend to click at the back of our mind, and this is what? Number one, talk about, we are talking of adjustments, or rather treatments of the books. So you'll find that one thing that will occur, I'll have to create goodwill, right? On admission or retirement, talk of this case, you'll have to do what? To create goodwill. So in this case, you're having goodwill. Adjustment or account that we'll have to prepare is a goodwill account. So in this case, on creation of a goodwill account, what are we going to do? On a creation of a goodwill account, what you're supposed to do, my good student, is I'm going to debit our goodwill account, debit our goodwill account, and you're supposed to credit our capital account, with the old profit sharing ratio. This, of course, on admission, with the old profit sharing ratio, okay? That is on creation of a goodwill. We'll have to do that with what? To debit our goodwill account, and you credit our capital account with the old profit sharing ratio. Then immediately after we've created it, you'll find that many a times we'll have to write off our goodwill. So goodwill written off. So writing off of goodwill, goodwill. We'll have to write off this goodwill that we've created. And in writing off the goodwill that we've created, my good students, this is what you're supposed to do. We are going to debit our capital account and credit our goodwill account with the new profit sharing ratio. With the new profit sharing ratio. This is very important to note. That is on creation of goodwill and on writing off of goodwill. So number one account that we must always tend to create is what? Goodwill account. Then you'll find that another key element that we must also be having at the back of our mind, it is revaluation. Maybe during that period you can decide to revalue our what? We can decide to revalue our goodwill, which in this case, you can, not our goodwill, but our assets, which in this case, they can either be revalued upwards or downwards. So you can either have a loss on revaluation, or better still, you can have what? A gain on revaluation. So number two treatment that will also be very key on these changes in ownership. In this case, we'll have to cater for what? Revaluation. So in this case, if at all it is a gain on revaluation, what are we going to do? If at all we are having a gain on revaluation, these are what you're supposed to do. Number one, of course, you are going to debit our asset account, and we credit our revaluation account. That is, of course, with a gain on revaluation. 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 The other account that you're going to do, that is number one. Number two, in this case, of course, we need to cater for that revaluation. So what you are going to do in this case, we debit our capital. That is, of course, we debit our revaluation account. We debit our revaluation account. We debit our revaluation account. And we are going to credit our capital account with the revaluation gain. With the revaluation gain. With the revaluation gain. With the revaluation gain. So basically these are the entries that we'll always be having in mind in the event that we are talking about what? Gain on revaluation. Remember, we are treating it in our capital account because recall, for partnership, if we are to look at our SFP, the only items that we'll be having in forms of equity, I'll be having our capital and current account only. That's why we are writing this off in our capital account. What about with loss on revaluation? Number two, we want to talk about with loss on revaluation. Loss on revaluation. Loss on revaluation of an asset. Loss on revaluation of an asset. So with the loss on revaluation of an asset, we are going to debit here our aspect of our revaluation account, and we credit our asset account. This is with loss on revaluation. That is with loss on revaluation. With loss on revaluation. With loss on revaluation. The other key that we need to do here is to debit our capital account, and we credit, of course, in this case, our revaluation account. We credit our revaluation account. Revaluation account. Of course, with what? With the loss. With the loss, or rather with a revaluation loss. With revaluation loss. So you'll find that basically these are some of the main entries that you must always tend to have at the back of your mind in the event that you're dealing with the concept of admission or conversion of a partnership into, or rather not conversion, but just admission, retirement, or death of a partner. Remember, there is a change in ownership. So basically these are some of the key accounts that you must always be having at the back of your mind. Now, once we have that, it will be very important that we cement this concept clearly. It will be very important that we cement this concept. And to cement the concept, I want us to consider an illustration question. Of course, this is going to come from our past papers. And what we are handling today, it is a CASNEB question. Recall the concept of partnership. It is in majority of the courses, which will include the aspect of NEC, CASNEB. Those who are doing ACCA, this should be F1, right? Partly, you'll also find that actually it will also apply to those who are in their degree level. And basically you're doing either BCom or you're doing aspect of BBM or any other course relating to business. This is very important for all of you. So in this case, I'll want us to consider this question. And below this video, on the description, I'm going to attach the link where you can get this question as well. So this is our question, my good students. I want us to go through this question and see what the examiner basically wanted us to do. So I'm talking of partnership. Just a moment here. I'm talking of a partnership which is April, a question from April 2022. April 2022. April 2022. April 2022 should be question number 2A, I think. Let me check. April 2022. Okay, I believe this is a question which I think is very clear. Should be question number 2. For those students who are in CPA CASNEB, you can check that question, April 2022, question number 2. The same, I've also shared it here on the screen, which I believe is very visible on our end. So I want us to go through this question and handle this question to the point that we'll always be very, very kind of comfortable anytime you're handling any concept to do with what? To do with partnership. So basically, these are what you're told. I'll go through it. That Jack and Nina were operating a shop dealing in designer bags as partners, sharing profit and losses in the ratio of 2:1 respectively. On 31st March 2021, they admitted Maria to the partnership. The partnership deed provides for interest on capital at the rate of 10% per annum. So clearly we can see I'm having admission. Clearly you can see we're having what? We're having admission of a partner. We're having admission of a partner, which this partner of ours was Maria. The balances as per the partnership books of account as of 30 September 21 were as follows. So basically in this case, I am given the balances in our books, which will include whatever that I was given there in details. Come to our additional information. Additional information, these are what you are told. Additional information, these are what you are told. That on admission of Maria, the profit sharing ratio changed to Jack 2:5, Nina 2:5, and Maria 1/5. For purposes of admission, goodwill was valued at 12 million and was written off the books immediately. So on admission of Maria, we created a goodwill, and this goodwill, the good examiner is telling us that this goodwill was written off. So remember the steps and accounts that Mwalimu has shared with us. Note 2, we are told that sales for the period to 31st March 2021 were equal to 2/3 of sales from 1st April to year end. That is very important. And I know this question, that was probably one of the areas which was tricky for students to analyze. That was one area which was tricky for students to analyze. And the good thing is that Mwalimu is going to solve it for us here. We are told that sales for the period to 31st March 2021 were equal to 2/3 of sales from 1st April to year end. Okay? Very important to note that. Note 3, I'm going to explain that very well while you will be working it out. Note 3, on 1st April 21, Maria paid 5 million, which comprised a fixed capital of 3.5 and a current account contribution of 1.5. Okay? Note 4, these are what you're told, that apportionment of gross profit was to be made on the basis of sales, while for expenses is based on time unless otherwise indicated. So any time examiner can tell you it was apportioned with time or it was evenly apportioned. So that is basically, we are talking of it on a monthly basis. With the exception in this case, we are told that the aspect to do with gross profit was distributed as how the sales were distributed. So it will be very important for us to know that and see how we are going to treat the same. So come to the other note where we are told, that apportionment, or rather talk of on 30th September 21, inventory was valued at 5.1. So that is basically our closing inventory, which was valued at 5.1. Now 6, allowances for depreciation on motor vehicles and furniture and fittings is at the rate of 20% and 5% per annum respectively based on cost. So ideally I'm also given what? Allowances for depreciation. Now 7, these are what you're told. Salaries included the following partners' drawings during the year. So the salaries that I was given here, out of these salaries that you are given here, salaries and wages of 7.4, it included these salaries which were given to, which were kind of drawings. So we'll have to treat that accordingly by deducting these drawings from our salaries. Note 8, we are told that as of 30 September 21, rates in advance amounted to 260, while electricity accrued amounted to 60,000. That one is direct, treating prepaid, which we'll have to deduct from our current expense, whereas accrual, because they were expensed on this year, it's only that we didn't pay, we need to add them, okay? Note 9, doubtful debts for which full provision was required as of 31st March 2021 amounted to 120 and 160 as of 30 September 2021. So in this case, we are talking about provision, doubtful debts for which full provision was required. So ideally, we'll have to consider either if we had a gain, or rather an increase in provision or a decrease in provision, then we'll treat it accordingly. Note 10, consultancy fees included 200 paid in respect to the acquisition of office building. These fees are to be capitalized as part of the building. The building is estimated to have a useful life of 25 years. So basically that will assist us in working out depreciation. Okay? So my good students, given such a question, where are we going to start from? At this point, I want us to start with note 1. I want us to see how we are supposed to treat note 1 on admission. I want us to see how we are supposed to treat note 1. And that is, of course, you are given note on admission of this new partner. So how will we go about it? That will be very simple because Mwalimu here has given us all the details required for us to treat the aspect of goodwill, for us to treat goodwill. So therefore, we have to prepare our goodwill account. Therefore, we'll have to prepare our goodwill account. We'll have to prepare our goodwill account. Just a moment here. We'll have to prepare our goodwill account, as well as our capital account, which will enable us basically to treat these items the way they're supposed to be treated. So therefore, at this point, I'm having, of course, okay. So this is what you are going to do. I believe that all of you guys, you're following Mwalimu here clearly. So, working it out, these are what we'll be having. Let us prepare this following our double entry that Mwalimu had shared. Following the double entry that Mwalimu had shared here. We find that these concepts, by the way, are very, very simple once you follow them clearly. I can re-squeeze this question completely so that at least it will give us space, which I believe is still visible, which Mwalimu is believing is still visible. So what you are going to do here, following the double entries that Mwalimu has given us, we are going to have our capital account. We're going to have our capital account first of all. That's the first thing that I will have to do. In our capital account, I'll be having the individuals here. Remember that you still recall the format of capital account, because I know it's not the first time that we are dealing with a capital account. I believe you still recall the format of our capital account. So our capital account, clearly you can see I'm given these partners of ours, Jack, Nina, and Maria. So I'm having, of course, our details here. We are having Jack, Nina, and Maria. Then, of course, my details here. Jack, Nina, and Maria. Okay, so this is our capital account. This is our capital account, which I believe you guys, you still remember the format of this capital account of ours. Our figures, recall our figures you are given in thousands. Our figures you are given in thousands, so that is what we'll be having. Our figures you are given in thousands. That is what Mwalimu will be having as well here. Once we have that, consider our balances brought down. Consider our balances brought down. Our balances brought down will just be clear as the way it is. If we scroll to partners capital account, I can clearly see I'm having Jack. So our balance brought down. Jack, I'm given 3,000. Nina, I'm given 2,000. This time round, we didn't have Maria brought down. But you're told we're told that on admission of Maria, the profit sharing ratio changed to 205, 205, 15. For purpose of admission, goodwill was valued at 12 million and was written off the books immediately. On the same note, if you were to go to note 3, on 1st April 2021, Maria paid 5 million, which comprised the fixed capital and 3.5 and a current account contribution of 1.5. So in this case, you're having either cash or bank, the amount that was introduced by Maria, which in this case, I'll give her 3.5, which the examiners told us. Then on this note, these are what we are told, that we created a goodwill. On admission of Maria, we are told that we created a goodwill. So following exactly the double entry that Mwalimu had given us, we are looking at on creation of goodwill. What are we supposed to do? On creation of goodwill, I'll be having my goodwill account here. On creation of goodwill, I'll be having our goodwill account, right? I'll be having my goodwill account here. Goodwill account, okay? In our goodwill account, on creation, we are going to debit our goodwill account and credit our capital account with the old profit sharing ratios. That is what we had agreed. So in this point, I'll be having my capital account here. Before admission, we are only having two partners, that is Jack and Nina, right? What was their old profit sharing ratio? Their old profit sharing ratio, you are told that their profit and losses, or they were sharing profit and losses in the ratio of 2:1. So I'm having here 2 of 3 times the goodwill that we created of 12,000. Then 1 of 3 times goodwill that we created of 12,000. So basically, this will give us a figure of how much. Mwalimu will pick his calculator. Mwalimu will pick his calculator and we work it out. I'm having 2/3 times 12,000. That should give us 8,000. 8,000 there, meaning that this one will give us what? 4,000. Where I'll have to debit what? I'll have to credit our capital account. So I'll come confidently and say I'm having goodwill here, goodwill of 8,000 and 4,000, right? That is on creation. We need to write off this goodwill. And on writing off, recall, we are going to debit our capital account and credit our goodwill account with a new profit sharing ratio. That is what we've agreed. So in this case, I'll be having these three partners of ours. I'll be having Jack, I'll be having Nina, and I'll be having Maria with a new profit sharing ratio. If we can check clearly in note number if you can check clearly in note number 1, our new profit sharing ratio will be 2/5, 2/5, and 1/5. So therefore, I can now also remove this question of ours. So basically, I'll be having our goodwill we've already created, which is 12 million. So I'll be having times 12 million here, times 12 million, times 12 million. Okay? So once we have that case, I'll be having 2/5 times 12 million. My good students, I'm having a figure of 4,800. This should give us 4,800. And the balance, of course, should give us 2,400. So saying that I've created my goodwill and I have written it off, so that as at the end of the day, my goodwill account will have balanced and I'll have cleared this account. So we have written off this goodwill account. We have written off that goodwill account, and therefore that is to say, in my capital account, I'll be having our, this is of course our goodwill, which we've just created. For Jack, I'll be having 4,800, 4,800, and Maria, 2,400, 2,400, 2,400. So in that case, I have created my goodwill and I have written it off. So confidently, I can come and determine now the capital account that we will be required to report in our SFP, in our statement of financial position, which in this case should give us what? Balance brought down, balance brought down, balance brought down. I'll be having my balance brought down here. Remember, in this case, if at all we are to balance carried down, if at all you are to talk of retirement, at times probably you find that the partner will have gone with an asset. Such items we normally tend to write them off in our capital account, which there's a question where you find, but that one was on retirement. You was told that probably a partner went with, say, a certain asset of the company, or rather of the partnership. So in that case, you'll find that such items, we normally tend to treat them in our capital account. But later on, we'll be looking at a question in relation to that. So here, I'd be having clearing our balance, that is 8,000 plus 3,000. This should give us, of course, 11,000 here. I'm having 11,000. This, of course, should give us 6,000. And this one should give us 3,500. So whatever that you're going to report, 11,000, of course, minus 8,000 here. 11,000, sorry, minus 4,800. 11,000 minus 4,800. That should give me a figure of 6,200. 6,000 minus 4,800. That should give me a figure of 1,200. Whereas 3,500 minus 2,400, that should give me a figure of 1,100. So when I'll go to my SFP, these are the figures that we are going to report as part of our capital accounts. So the question was for us to prepare income statement and statement of financial position. This was part of our working. I want you guys to join me in the next session where we are going to clear this question in full. We work out income statement and we proceed to prepare our current account. Then finally, we'll also prepare our SFP. To that point, guys, thank you so much. I was your instructor, CPA Ringo Frederick, and as we have said, you can get this question below the description of this video or on the comment section. Thank you guys, and let us meet in the next session. Thank you.